CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for September 21st, 2020. Please see our disclaimer for important information. In the chart pack this week, we revisit our old chart here, covidtracking.com, 7-day moving average, caseload, as well as new daily deaths. You can see that this kind of continues the slight uptick trend that we saw last week. Obviously, we've got back to school issues and the incubation period for some of the institutions that opened up over the last few weeks. We are seeing a slight uptick in volumes, but obviously we need to continue to track that for activity here in the U.S. So something I want to make sure that everyone is clear on is that even though we've seen some mitigation here in the U.S. on caseloads, despite the slight back-to-school uptick, it's clear that globally we're seeing a fair amount of case growth, particularly in Southeast Asia. You can see the chart on the right. We've had perhaps a little bit of increase in Europe as well. Americas seem to be tracking down a little bit more, but that's where you find the greatest volume of cases still in aggregate. But you can see the global number on the left, which is an aggregation of all, and then obviously on the right you can see it broken down by sector. So as we continue to kind of explore and examine the plight of small business, this is something that if you've been listening to these presentations over the last few months, you've heard a consistent theme from me, and that's recognizing the issues that small business owners face with regard to fallout from the pandemic. Now you can see here, this is actually putting numbers into motion here, if you will. I've got a few slides from Yelp, which kind of give you some perspective on the rate of permanent closures of small business as we track from the kind of the heart of the pandemic in April through the end of last month. And you can see clearly that red line, the permanent closures, have continued to go up. The total numbers of business closures had reached a bit of a soft point in July, but as we saw caseloads rise, new restrictions put in place, that number continues to rise. And what we hope is we see that red line at least abate its growth and go back down. This is kind of broken down by sector with a quote that I pulled off of a First Trust COVID tracking type weekly publication, which I think just drives this point home that we saw on the previous chart. We've seen a lot of impact to restaurants. Retail has been one of the most poignantly hit areas of the market. You can see, the rate of closures, permanent closures, and aggregate closures, and those numbers are still very, very compelling. And without necessarily reading that comment on the right, you can see clearly that number is very appreciable, and the percentages of permanent closures are very, very strong. In this slide, we examine the lending environment for small businesses, and it continues to be very tough. If you look at the first few lines where you've got under $1 million, 1 to 5, and then 5 to 25 million, you can see that there's been a net contraction on loans by lenders. Now, these do not include the PPP loans and those subsidized loans run through the SBA program. This just reflects core banking activity, and you can see that lenders are much more persnickety on lending to small businesses. Now, if you're a large business, they're at the bottom over 25 million, then you've clearly seen percentage of growth is 7% here. But if you look at those smaller cohorts, it's been very, very challenging for small businesses that are not getting the loans or having to close permanently. Again, it's just kind of it's a very unfortunate, but almost like a looped cycle, if you will. And as you might expect, with small business accounting for almost half of all employment out there, if small business is struggling, then and a lot of these small businesses, frankly, are comprised of income earners that really don't make a whole lot. You think of small businesses from house cleaning to window washing and things like that, and in many cases those businesses don't make a lot of money, and so you tend to have maybe a lot of entrepreneurs that are kind of at the lower income boundaries, but they're hardworking people, and they make a consistent income when the economy's fine. But in this environment, it's been very challenging for them, and obviously, as we've seen already in the chart pack thus far, a lot of them have had to close their businesses permanently and not have access to capital. Here you can see that basically that those the bottom 40% of households by income account for 20% of overall consumer spending, which in and of itself accounts for almost 70% of our economy. So this has had a trickle down effect. Now we haven't seen it manifest itself yet in the data because we're still a little bit of a lag, and there's still people that we're still getting this data from June, July that reflected some of the stimulus payments that have since gone away, and we'll see later that the appetite for new stimulus is very, very low. So this makes kind of what I'll say I'll term it a kind of an unsettled situation with regard to the economic outlook, just because there is so much turmoil at the lower income cohorts and so much turmoil at the small business level. This chart just simply reflects over the last half year the best and worst job growth, as you might expect. Service businesses have been most impacted. You can see performing arts, accommodations, which is hospitality, transportation, sightseeing, and scenic. These are all discretionary spending type areas: arts and entertainment, recreation, amusements, gaming. So not too surprisingly, you've seen a tremendous contraction in job growth there, whereas we've seen in federal government, which some of this reflects census employees and essential services, if you will, couriers, messengers, and whatnot, that you've had some net growth, and then just overall you've seen more growth at the federal and at the government levels. This is another chart that kind of reflects household income cohorts, and this drills down a little bit further beyond perhaps some of the charts that you've seen before. But if you look at, again, we've already talked about how the lower income cohorts represent a meaningful percent of consumer spending in the aggregate. And you can see here that poorer Americans have been more greatly impacted by the pandemic and by the business environment that persists at that small business level. And you can see that clearly, as you move from left to right, there's been less impact on the higher income earners than there has been on lower income earners in terms of percentage loss of income since March 13th. That's in the black. And then expected loss of employment income over the next 4 weeks. This is a kind of a forward-looking number, and it's a similar pattern that you can see, that the expectations are lower, or excuse me, I should say rather, the expectations are for higher income loss, if you will, for the lower income levels. This is another look from some data that we got from the Financial Times, as kind of reported by the Luthold Group up in Minnesota, a group that I know really, really well. But this just reflects, essentially companies, as it says in the data line there, where profits are less than the interest paid on their debts for 3 consecutive years. So just think about that. That interest paid on debts is greater than profits of the company. So these are companies that are clearly not expanding, they're contracting, they're burning cash on their balance sheets, and they're just they're not going anywhere basically. And so we call those zombie companies, and these are companies that are in the Russell 3000 equivalent. Again, Luthold is the group that's kind of put this together, but it really represents kind of a proxy of this small business environment. So kind of looking, looking at that smaller company environment that we've been talking about, today in the chart pack, you can see that the publicly traded small companies are impacted here too, because essentially now we're back at the 2000 peak for zombie companies in the Russell 3000 index, which is pretty astounding. So this is our confidence factor that I mentioned earlier about whether there will be more legislation, and I think you can perhaps scroll back and watch this later, but you can see the change in the numbers in the between 1st of August and 31st of October. That number clearly going down, and then not before January 2021 number going up. So what this is telling you is that the appetite overall and the expectation overall for follow-on stimulus as we inch ever so closer to the election continues to go down. This is a chart kind of getting into a little bit of economic stuff here. The G10 countries, these are the developed economies. The output levels are forecasted to return to pre-crisis levels sometime in the second half of next year. That is essentially the forecast by a host of different survey entities, one of them being the International Monetary Fund, and you've got some Wall Street banks, and this is kind of an aggregation of that. But you can see how that compares with the 2008 global financial crisis, where we did not see the level of economic destruction that we did here with these forced shutdowns in many of these countries. But the expectation is that we get back there sooner. Obviously, the proof will be in the pudding, but you can clearly see in another environment, 12 years ago, it clearly took a lot longer to recover that lost output. And so I think that coupled with the fact that we had a greater magnitude of economic destruction in what happened this year, I think at least leaves the door open for speculation that it might actually take a little bit longer for the global environment to recover from this. Another thing that we've been tracking has been real interest rates. Obviously, real interest rates have chased dollars into financial assets, where we've had some inflation there. It's chased money into gold as a store of value, but you can see the difference here between essentially the developing economies versus the developed economies, and we still have a risk premium associated with those developing economies that continues to make their real 3-year government bond rates positive, whereas most of the developed world it is negative. And clearly in the U.S., we're down about negative 1.3 in real rates, and that really kind of encompasses both a low nominal rate, which is the rates that you see published in the paper and get announced on the news, minus the inflation, which remains low right now. And we've got a chart that's going to speak to the issues that there are some areas that are experiencing higher inflation, but net we really don't have a whole lot of inflation right now, but we know that the Fed is going to let that inflation run before they do anything about interest rates. So we know the prospect certainly exists for higher inflation down the road, and we just really don't have a lot of maneuvering room here in the developed world as far as being able to manage interest rates down to spur economic growth. This is the Federal Reserve, or excuse me, the Federal Open Market Committee, FOMC's dot plot. Now these are estimates that are put forth by the voting members of the Federal Open Market Committee, and these are the people that set interest rates. And this is something that's followed by policy wonks and people in the institutional investing sphere to kind of get a sense of where the Fed members themselves really feel like interest rates are going to go. And Fed funds is essentially about as short term as you can get. It's essentially the overnight borrowing rate to banks and financial institutions. And you can see very clearly here that they're not projecting any rate increase until 2023. And just kind of digest that for a second, that we have 2 years of this rate regime. And if you recall, there back in the wake of the global financial crisis, I mean, we had zero interest rates or near zero interest rates for a very long time, and it led to asset inflation and some other things. So obviously, they're very committed internally by virtue of their sentiment here to keep interest rates low, to hopefully, in their minds, allow inflation to kind of get up closer to inch up on an average basis, inch up closer to their 2% target. But a long story here is expect the short interest rates and savings rates and commercial paper rates and money market rates to remain low for a long time. And conversely, this is a survey of professional forecasters from the Philly Fed, which says that they don't see inflation rising to the 2% Federal Reserve target for a long time. And the black line represents the expectation over 5 years, and the lightly colored pinkish line, if you will, is over the next 10. And so there's really not a lot of confidence for inflation to get up to that 2% target, which really means if you believe this, then you're not going to have a lot of interest rate movement on the short end of the curve for a very long time. And if your inflation expectations are low, which inflation expectations drive longer term rates, and if you don't see that manifest, then the whole interest rate curve is going to remain fairly low, positively sloped, but overall interest rates and your yield curve is going to remain low for a long time. Okay, so a couple of segments here. We have consumer price index for food as well as healthcare, and so I pulled these out of, there's no attribution here, but I pulled them out of the Daily Shot newsletter that I get, and believe these might have been pulled out of Morgan Stanley, some pieces that they put together. But you can see that 2020, both food and healthcare have gone up, as you might imagine. Food is, I think, in some cases have been a run on because people are not dining out, they're eating at home, and so food costs are going up. They're expected to mitigate, as you can see here on that red on the left-hand side. But healthcare is going to be very, very interesting, even though the pandemic has kind of really allowed new therapies to be pursued at just breakneck speed, and we've kind of pushed new technologies to the forefront of the healthcare space. It's creating a price regime that continues to go up, and we're going to have to see how this plays out, because we certainly don't need a large rise in healthcare costs, and these are producer prices, so these are going to manufacturers of healthcare gear, but obviously if producers see it, then they're going to pass along those costs to consumers. And you can see in the black or the really dark blue line here on the right-hand chart that household consumption expenditures. These are prices for healthcare items that the household pays, and those are also going up. So we're really going to have to monitor what happens in healthcare spending as we go into the next year and well beyond. Well, this chart underscores the roller coaster that we've seen in the S&P 500 dating back to last February, and really, if you blinked, you kind of missed it, and you feel like if you were not paying attention. Obviously, it was very painful and visceral on the way down. As curious and odd and and strangely euphoric as it was on the way up, but it only took us 126 trading days to reattain the levels that we were on February 19th. And you can see if you look back at other bear markets, and this is not I'd say it's a representative sample, but not all encompassing, that typically it takes a lot longer to retrace that low in a bear market. So this has been very, very unusual. Although certainly the backdrop has evolved. We know the plight of the small business owner, which we've seen. We know the issues with regard to low income earners that do account for a lot of our spending, and some of the issues that they face or potentially face if there's no new stimulus forthcoming. And we've already seen the issues related to or probabilities related to whether that stimulus is going to come even this year or not. So it's very curious that we've seen this retracement in such a short period of time, yet those risk factors have evolved, and they're very much under the surface here. It's a little busy chart. It's from BKA Research, which is based up in Montreal. And they do a really, really good job of kind of mapping out several things. And this is really kind of diving into the market now. So the last chart we showed that it only took us 126 trading days to kind of retrace that entire drop from the third week of February. In the top part of this, you can see the S&P 500 itself, which in a microcosm on the far upper right side of that chart, you can see that the dip from February to March, and then the subsequent recovery to kind of get us back to that long-term trend line dating back to the global financial crisis. But if you go down, you see what they call the PEG ratio, which is price to earnings ratio divided by growth. And so if you think about this, this is kind of a multiple of earnings divided by the growth rate. And so very simplistically, if you had a PEG ratio of 1, that means your price to earnings ratio, or the stock valuation, or the valuation of the market rather, which is what this case is equal to its growth rate. And in this case, it is 2 times right now. So meaning that the price of the market, the price to earnings ratio of the S&P 500 is double its growth rate. And that's pretty profound, because if you look at that second chart with those dotted lines, each one represents a standard deviation. And not to get too mathy, but basically if you get 2 standard deviations away from your average, and the average is about 1.25. So basically the price to earnings ratio is about 1.25 times the growth rate of the market. But with each dotted line above that, it gets much, much more rare. And 2 standard deviations means that you're above 95% of all observable instances. So when you get up to 4 standard deviations, which is kind of where we're at now, that is really, really rare. And you can see in the third chart bracket there, the forward price to earnings ratio, we're above 22 times, which if you go back, again, you've got to go back to the tech bubble to see a price to earnings forward PE ratio where it is now. So that's very profound. If you kind of think back on this recovery, the last 126 days, where we've had this kind of euphoric rise in the market, but when you look at the PEG ratio, it's expensive. You look at the forward PE ratio, it's expensive. And if you look at forward earnings expectations, which have really troughed here, and we're actually going down even before the pandemic, that makes for a very, well, I didn't say very, but a potentially volatile environment over the next couple of years. This is a global fund manager survey, is kind of reprinted, if you will, by Bank of America Merrill Lynch. And again, we've got an environment where we feel like perhaps, by virtue of this PEG ratio, that the market may be a little stretched, a little expensive. We're in rarefied air as far as that ratio goes. But yet, in this one, we have investors, and these are fund managers. These are professional investors. So these are ideally, you'd think the smartest of the smart here represented. And what this tells you is that net, essentially 40 to 60% of them feel like earnings are going to improve 10% over the next 12 months. And that is a big reason why that you see that high PEG ratio and still see a lot of confidence in the market, because with the earnings rate being fairly low, the earnings forecasted growth being fairly low, and this ratio being high, people feel like, okay, well, the price is not as important here because we know that earnings, or we feel like earnings are going to improve. And suffice it to say, the people that are represented in this survey control a lot of money in the market. This is gold. A lot has been made in gold lately. We've talked about it. We follow this chart. It had a very profound rise in July and early August, and we've seen that temper a little bit. And this is kind of a technical line, if you will, of support. And you can see where gold prices are consolidating around really kind of that around that 1940, 1950 level. And unless we have a strong kind of change, if you will, in interest rates, and particularly real interest rates, you certainly wouldn't expect a profound drop in the price of gold, but you can see it continue to kind of consolidate around current levels. This is an oil to gold ratio mapped against the U.S. 10-year break-even yield, and this is kind of a convoluted chart. But let me break down the components. So, in that in kind of that lighter colored line that you see there, that's the oil to gold ratio, and that's represented on the left-hand scale. And so basically what we've seen is that the price of oil relative to gold has gone down consistently over the last decade, and has really kind of dropped here so far in 2020. Now, at the same time, if you look at the 10-year break-even yield, and so what this means is basically the 10-year basically the inflation proxy. This is what is implied about inflation rates within the 10-year treasury rate. And so what it tells you is that there's a pretty strong relationship here over time between this oil to gold ratio and 10-year inflation expectations as built into and as expressed by the 10-year treasury note. So what's interesting here is that we've had a decoupling during 2020 where the break-even yields, basically the inflation expectations, have gone up, which has made for negative real yields, and oil has gone down. You typically don't see that. You typically see gold move, or this ratio move in tandem with that. And some of this has to do with the fact that oil has dropped so low at a time where gold has gone up. But it's very interesting to see this relationship here. Well, that does it for our charts of the week. Hope you've enjoyed our presentation. Welcome your questions and comments to the information that you see on the screen. Love to hear from you. I hope you have a safe week, a good week, and we look forward to seeing you very soon.